Some examples, as well as reviewing some of your Connect assigned problems. The first one we'll look at is example 11-11 on page 1117. Here Zeke is entitled to receive monthly payments of $2,000 over his life from his employer's qualified pension plan. He contributed $97,500 to the plan, so that portion of each payment would not be taxable. He's 64 years old. Zeke will be able to exclude from each $2,000 monthly payment $375 from taxability, and the rest of the payment of $1,625 would be taxable at ordinary income tax rates. So we know that Zeke contributed $97,500. The question is, how many payments do we expect to have to pay to Zeke? If we go to the table above, we see that 64 years old falls between 61 and 65. So that's 260 anticipated monthly payments. So we'll divide the amount he contributed, $97,500, by the 260 anticipated payments, and then we wind up with the $375 excluded from taxability per payment. And as I said earlier, the rest, $1,625, would be taxable. All right, we'll go down then to the next example. Example 1116, Mort is unmarried. His 70th birthday was March 1st, 2019, so he reached age 70 and a half on September 1st, 2019. That means the first April following this point, he has to start making minimum withdrawals, or we call distributions, from his plan. So when we look at the data, his retirement plan has $300,000. He needs to calculate his minimum required distribution for 2019. So at the end of 2019, he'll be 70 years old. As we said, we're going to use table 3. And this is the life expectancy table used to calculate his 27.4 years. So let's take a look then at table number 3 in your appendix and find how many years of life expectancy he has. So here's table 3 in the end of your text, and you can see if he's 70 years old, he's got 27.4 years left, expected or anticipated life left. So we would divide his $300,000 by the 27.4, and this means that he must receive at least $10,949 from his retirement plan. He has to withdraw the minimum of $10,949 in order to avoid tax penalties and tax consequences, other than taxing the benefit. All right, so the distribution may or may not be taxable. It depends upon the nature of the fund. However, we do know that if he is subject to these required minimum distributions, then he is going to have to take out $10,949 from his retirement plan no later than April 1st of 2020. In your Connect assignment, I'll be going through some of the problems you'll be facing. And in the first one, Terry is single, 32, AGI 70,000, is an active member of her employer's pension plan. Well, certain kinds of pension plans, of course, like traditional IRAs, are subject to phase out based on AGI, and in this case, Terry is above the minimum AGI threshold. So we need to calculate what is the maximum deductible IRA contribution that she can make in 2019, and this is to a traditional IRA. So as a hint, I've calculated the percentage for you that is subject to the phase out, and it's your job then to calculate the amount phased out from the maximum contribution that she can make. In the next one, Mark is single, starting to make distributions or take distributions from his pension plan on April 1st, 2019. And they give his age, and they have a balance of $220,000. They'll give you 3 tables in Connect to select from. Just as a hint, you're going to use Table 3. And please use the approach that I demonstrated earlier in the textbook example when solving this one. But you can ignore Tables 1 and Table 5. You don't need those in this problem. Just use Table 3. And then follow the procedures that I went through earlier. Julio is 62 and single. He purchased a single life annuity contract that will pay $1,000 a month. Again, in this case, we're going to use Table 5 because this relates to an annuity. Also, please note that these are monthly payments. So you have to factor in the fact that you have 12 payments per year when you're solving this problem. All right, so use Table 5, and in this case, multiply the number of years that you determined from Table 5 by the amount of the monthly annuity payment, and then you'd multiply that amount by 12 to determine the amount he can expect on this contract. This one is similar, just some different situations here. We're going to determine the tax-free amount of the monthly payment. Again, the tax-free amount is the portion of the payment that the taxpayer contributed to the plan. And here we use Table 5 in the appendix, so you can ignore Table 1 and 3 for this particular problem. The exclusion percentage is the cost of the contract, as we said, divided by the expected return on the contract. And of course, the excluded amount is the amount equal to the payment received multiplied by the exclusion percentage. So these are independent situations. Look at the age of the person, go to Table 5, determine the factor, and then apply the procedures that we went through earlier to determine the tax-free amount of the monthly payment. Here, Thomas is self-employed. He's a plumber, age 50. His earnings from self-employment before the KEO deduction, but after deducting half the self-employment tax, is $80,000. What is the deductible KEO contribution for 2019? Here we want to set up that algebraic expression I went through earlier in the first video. And I've set it up for you here. Then you're going to take the lesser of 56,000 or 25% of X. So X is not your answer, but 25% of X is the amount you'll compare to 56,000. Take the lesser of the two. And again, I went through that particular example, but with different values in the first video. And then Jack is single, age 53, reported AGI of 71,000, active participant in his employer pension plan. Okay, single, again, this is very much like the earlier problem. Please remember, though, that when you're calculating using the phase-out, this is the amount disallowed. But the question asks, what is the maximum deductible contribution? So when you calculate the disallowed amount, just like in the earlier example, you're calculating using this ratio here. You're calculating the amount to disallow. But you'll have to deduct the disallowed amount from the maximum contribution to determine the allowable amount. Vanessa and Martin file a joint return, have one child. They have combined AGI of 202,000. Maximum contribution to this education fund. Well, again, we have a phase out. And again, remember, this is the phase out is the amount disallowed. They're asking, what is the maximum permitted contribution to the Coverdale Education Savings Account? So you would take the amount disallowed and net it from the maximum contribution to determine the amount of the contribution that this taxpayer can make. that these taxpayers can. And then finally, June age 76, Augustus age 78 are married. They purchased a single life annuity contract, single life, that will pay $1,500. Well, since it's a single life annuity contract, we can ignore the information that relates to Augustus. So here we're going to use Table 5 from the appendix to determine the factor, then take the monthly payment times the factor times 12 months per year to determine the expected return on this contract. If you have any questions on any of the concepts we've covered in Chapter 11 or the assignment, please let me know.